Well, I think that what we've gotten right over the past few years is the resilience of the economy, which is then, of course, related to the resilience of the consumer. And I think I sort of had inside information. I'm a baby boomer, and I'm seeing all my friends retiring. And then I'm looking at the data from the Fed, and it shows that the baby boomers have $80 trillion of net worth. It's the wealthiest generation ever to retire.
Thank you.
And, I guess some of them intend to spend it all because the kids didn't listen, they didn't clean up the room, whatever. But it's a lot of money. And I also see a lot of my friends helping out their adult kids with mortgage down payments, with mortgage payments, and with the kids, after school activities. So there's a lot of trickling down going on. And I think the consumers been resilient. I've also been talking about the digital revolution with the technology boom. I mean, it was back in 2020 that I started to posit that this could very well be the roaring 2020s, and so far, so good.
So far, so good. And on that front, I've told my kids the last check I write is going to bounce. So, get to work. So, Ed, given that backdrop here, what is your view of this economy here? I mean, the labor market, people are a little concerned about the labor market. How do you think about that?
Well, one of the reasons we talked about the roaring 2020s is we anticipated that there would be a slowdown in the availability of labor. Baby boomers would be retiring, and we also would find that as a result of that, companies would be under a lot of pressure to increase their productivity.
Yep.
And perceive that there are a lot of technologies that existed in not too long ago in 2020, and that we did spotlight that AI could be an important technology. Never expected it would just come out of the blue in 2022, but it did. And so we think that technologies are there to increase the productivity of workers. And we're seeing that just even now. I mean, second and third quarters looks like real GDP is up almost 4% each of those quarters. Yeah. And at the same time, the BLS has been reducing the forecasts in anticipation of what the labor force will be. That adds up to tremendous productivity, which is great for real purchasing power of consumers, by the way.
Ed Yardeni with us, folks. The celebration is Friday after Thanksgiving. We welcome all of you. Paul, help me. 1 p.m. is equities close. 2 p.m. bonds.
Right.
It's nuts. Why do they do two separate times?
I don't know who's in charge of this stuff.
We welcome all of you across the surveillance nation on all the ways you listen to us on YouTube. Subscribe to Bloomberg Podcasts. And, of course, we welcome Bloomberg Television worldwide. A special good morning. Jumana Bersetchi in Dubai.
She's pretty solid.
Killing it on Horizons.
Awesome. Yep.
Good morning in the Middle East on this special day for America. Futures up 11, Dow futures up 48. Ed Yardeni with us as well. I want to describe this, Ed, because I think it's important. James Tobin came out of Harvard studying under Schumpeter. Mm-hmm. Basically, the Nobel Prize this year, folks, was the Nobel Prize Schumpeter never got. Went down to a school in New Haven, Connecticut, and under him was Willem Bouter, Edmund Phelps, a young lady, Janet Yellen, as well.
Willem and I were there at the same time getting our graduate degrees.
It's just really austere. In the heart of Tobin, in his wonderful eclectic economics of the 20th century, was pay attention to nominal GDP. To me, the great missed call here to bring it over to corporate is animal spirit.
Yeah.
Does your bull market extrapolation hinge just simply on nominal GDP?
Well, it does. Certainly, nominal GDP runs profits, and profits run nominal GDP.
And runs revenues.
And runs revenues.
At the top of the income statement.
Right. And, profits typically lead to companies expanding their operations in both labor and in capital. In the current situation, as we just discussed, there's a shortage of labor. So we're seeing a lot more spending on capital to increase the productivity of labor. And it's all good. Productivity is like fairy dust. It makes everything better. It makes real GDP better.
Right.
It makes inflation lower. And so you still get an increase in nominal GDP, but it's the right mix.
Let me get one more in here because Paul's got like 8 questions. With that said, when you look at Mag 7, which you have nailed, they're not under the same microeconomics of traditional corporations, are they? Discuss that.
Well, they have, some of them have moats around them, and it's kind of like Game of Thrones where, one is rising and another one's falling, and it's a very dynamic situation. But they do account for 30% of the market cap of the S&P 500. But they also account for something like 25% of the earnings.
Paul, can you see Zuckerberg going, cue the dragons?
Exactly. Yeah. So, as we think about what a lot of people have called concentration risk in this marketplace, is that a risk to you? How concerned are you about it?
Well, it's not a concern to me because these companies are earning a lot of money and they have a tremendous amount of cash flow. And they also basically have internal investment banking departments where they are able to find small companies that they can leverage up in their businesses. I think it's one of the reasons that small and mid-cap managers have been frustrated because anytime that they put in the next Microsoft in their portfolio, it gets bought out.
Exactly. You know? Well, how about for the small and mid-cap investors out there? Presumably lower interest rates should help those companies. Is that enough?
I think we can see it in the way things trade. Whenever there's expectations that the Fed will lower rates, the Russell 2000 does better. The problem is the Russell 2000 has something like 40% of companies that don't have any earnings. Yep. That's a little bit of a problem. But when people are excited and risk on, they're willing to buy those kind of companies. But my preference is I call them the impressive 493.
Yep.
Everybody's focusing on the Magnificent Seven. There's 493 companies in the S&P 500 that are benefiting from what the Magnificent Seven are creating. These companies, the Magnificent Seven, aren't going to continue to do well unless their products really do improve productivity for the 493. I think that's happening, and I do expect that the market will broaden out.
What is our Federal Reserve going to do here? I think the market's saying December we're going to get a rate cut. After that, not sure.
Well, the Fed really frustrates me. For the past few years, every now and then I've written that I'll be more than happy to do what the Fed does for half the price. And my condition is I continue. If they allow me to work from home, I wouldn't do regulation or supervision, just macroeconomic policy. But a year ago, when they started cutting rates, they're down 150 basis points since September of last year. I said, I don't think that's a good idea because the economy's doing pretty well and inflation's still above 3%. But they just wouldn't listen to me. They did it anyways. And you know what? The bond yield went up last year. Remember? They cut the Fed funds rate by 100 basis points. My friends, the bond vigilantes, took it up 100 basis points.
So Taylor rule with plugins. I can go 8 ways here, folks, on the plugins of Taylor rule. I'm going to say this, Dr. Yardeni, as clearly as I can. With the pandemic and with this original productivity experiment we're working, they're flying blind.
They're flying blind.
They're with me, Pharaoh, Bramo, sitting on the set, the Fed decides we're making it up as we go.
Well, they basically admit as much in their dot plot. In the dot plot, when you ask what is the neutral rate, so on average we think it's 3%, but then when you look at the dot plot, it's somewhere between 2 and 4% is the kind of range you get. So they have no idea what the neutral rate is. I think you have to look at the neutral rate ex post after the fact.
I got one final question. Kurt Soup is out in Indianapolis for Creative Financial Group, and he's writing up these brilliant mistakes you make in retirement tweets, real value add. Kurt Soup, S-U-P-E. Can't say enough about how he gets you thinking. How is Ed Yardeni saying we should invest if we're all going to live forever?
Well, I think the baby boomers especially were raised by Spock, and I know Dr. Spock has some influence on our mothers, but Spock from Star Trek basically told us live long and prosper, and that's what we've been doing. So I think all investors should assume they're going to live long, and along the way they should let the magic of compounding really make their retirement very prosperous.
Michael